Hey everyone, it's Sunday morning. If you hear a chicken cackling in the background, you'll know it's Sunday morning. I don't think I've ever done a video on a Sunday, but I was so occupied with business travel on Friday that I didn't have time to do what I thought would be an important video, kind of catching up on some important index ideas. We had quite a week last week in terms of economic data. On the whole, the picture painted was of a weakening economy, still a very poor jobs market. I was stunned, even I was stunned to see that of the jobs that were created, most of them were actually at McDonald's. It sounds like a joke, but it's actually a pretty sad commentary on where things are. That the lion's share of new jobs were created flipping burgers and asking, do you want fries with that? Pretty sad. The blank fiends of the world have absconded with all the money, and the rest of folks are left to work over a hot grill. Pretty pathetic. From a hardcore former libertarian like myself, it's enough to turn you socialist. Anyway, let's look at some index charts as we see the madness unveiled before us. We'll start with the NASDAQ Composite. And in this case, it's rather interesting because there's a trend line that's been in place since March 2009, which is hard to see, but if you zoom in, we are just at that trend line right now. And so I think Monday and the week as a whole will be very telling, because you could argue on one hand that the selling's been so fierce, and that if we're down to the levels of that long of a term of trend line, we're bound to bounce. It could happen. I think as we look at other items here, we can see that similar trend lines have already broken, and an item like the NASDAQ Composite is simply pending its break. Looking at the Indu as an example, we can see that this has indeed already happened. The trend line was broken on Thursday, and that break was affirmed resoundingly on Friday. So this has, as is the magical purpose of trend lines, changed from support to resistance. So I think any strength on the market's part will simply be a desperate clawing to the underside of that before tumbling away again. Now, the risk here, of course, is that broken trend lines can hold as resistance, and yet the market can still go higher, as we saw here. This is a break of the wedge, new highs, and we're back down here again. So it doesn't mean that it's just a straight fall down. This thing could creep along the bottom for God knows how long. Don't think it's going to. I think that we've got at least the first half of June in bear mode. Let's look at technology, which has been rather weak. A couple of interesting things here. Not only, and the trend line is all very similar because they span from March with a touch point in late August, and then Jackson Hole came along, and we've been climbing ever since. But we broke that one, and there's a kind of just a suggestion of a head and shoulders here, rather small, but even ignoring that pattern, challenging the lows of April 18, I think is an interesting phenomenon, because we've broken this, and I think falling away from this top here could be swift. Now, probably the most interesting index chart of all to me is the Russell. Now, just to recapture some history here, head and shoulders on Russells tend to be worth watching. The big kahuna here was spanning from October 2005 all the way to October 2008. So 3-year pattern, rather well formed too, I might add. And then we had this glorious plunge. Those were the days, huh? Look at this, falling very, very hard, losing half its value even from the neckline. Now, until recently, we were at lifetime highs ever for this index. Not recovery highs, but lifetime highs. And the trend line is still intact right here. However, this head shoulder is rather well formed. A little bit Muji on the neckline here, but a measured move on this would take us down to this green tinted area, something like 763, added to which it would break this trend line, which I think would be nice affirmation of the other indexes. Not to look too far ahead, but what I imagine would happen is along these lines, and this is probably the most important part of the video. If I were to speculate about the next couple of months, I would say a fall down to this level. A belief on the market's part that, well, we've fallen far enough that, Bernanke will come out with some, and I'm so sick of Q83, but come out with some new program, some new something to boost assets. And that would push the market rather broadly, late June, all of July, some span of time, higher. Now, let me, not to gobble up too much of the video with this portion, but this is an important point, so I just want to get through this. Let me just scooch this aside. Zooming in again. What could well happen here is we've got this, and then we'll go down here to about this level, and you can probably see where I'm going with this, and then we push higher right to around the 830 level where there's a lot of overhead supply, and we move down like so and then really fall. In other words, shoulder, head, and this would end sometime in June, and then another shoulder, and we'd be into that magical month of October, and then really move down hard. Just to really go out on a limb, the things pushing this, I believe, would be the strong belief that the government will in some way ride to the rescue. Maybe the dollar will plunge to lifetime lows during this period when we're pushing higher. But that shoulder here, I think, will, if it does transpire, will set us up for a really meaningful fall down to, say, 650, something like that. Maybe we'll get our own 666 on the Russell again. But, a nice autumnal crash, which would be pretty sweet. So that's all I got to say about that. Now, let's look at the S&P 500, and let's change this back to my standard 10-year daily without quite so much white space. This one isn't as super clean as the Russell was, but we have, again, broken, and this is significant because this is probably the widest followed index. We have broken that trend line. Returning to the notion of a fall this month, the numbers I'm hearing tend to be 1230, 1250, 1280, some area in here. I think getting down to about 1240, 50 or so, in other words, revisiting the March 16 lows is quite plausible. It also kind of makes sense because this line here is so significant. It was very significant when it broke it in December on the upside, and I think we will approach that level before a very meaningful bounce of 100 points, something really big. Funny thing though, on the VIX, Friday it actually went down, of all things, which I guess that makes a certain amount of sense since the unemployment numbers are behind us, but on the other hand, the volatility and the drop in the market, it's kind of surprising. So in a way, kind of comforting, making room for more volatility. Wrapping up here, a couple of last items. GDX, perpetual favorite of mine. Got a medium-sized short position in this. I believe that given the fact that the dollar has been so terribly weak and yet we're still seeing equity weakness, should the dollar get some strength, I think this thing could be in extraordinarily serious trouble. Like we'll be back into the 40s within a matter of a couple of weeks. This is a very, very vulnerable market. Last one is UUP. I only bring this up because we've had a wonderful time as equity bears recently, and I think that since that's in the face of staggering dollar weakness, that's only that much more encouraging. Because if we had dollar strength at our back, imagine. So getting ready to close this gap, worth watching. Well, I'm off to read the Sunday paper, so that's it from me. Have a great week. Bye.